Your credit score. It's a game and we'll teach you the rules. If you look back at the historical record before the modern era of computing, the concept of assessing financial trust was, well, a highly localized and rather tedious affair. In the United States, during the 19th century, merchants would often keep small, leather-bound ledgers, noting down the character, the habits, and the repayment tendencies of local townspeople. This system, which was entirely subjective, relied heavily on personal reputation, neighborhood gossip, and the subjective opinions of small-town shopkeepers, who would write down simple descriptions, such as, for instance, good for his word, or perhaps, frequently late with payment for flour, which served as the rudimentary basis for early American consumer credit. As communities expanded, and as the nation grew more interconnected through railroads and industrial expansion, this decentralized method became increasingly impractical, leading to the creation of formalized mercantile agencies, such as the one founded by Lewis Tappan in 1841. This agency, which later evolved into the Dun and Bradstreet Company, sought to centralize information, gathering details from correspondents across the country, who would mail in handwritten reports regarding the financial standing of local businesses and individuals. These early records, which were stored in massive, dust-covered filing cabinets in central urban offices, were organized alphabetically by state, then by town, and finally by the individual's surname, requiring hours of manual searching whenever a lender requested an update. Now, you might wonder, and yes, many financial historians have wondered too, what exactly happened next to these handwritten ledgers. But before we discuss that, there's something rather unremarkable about the specific ink used in those 19th century registries, which was often an iron gall mixture, prone to fading over decades, making the tracking of historical debt an incredibly slow, visually straining task for the clerks of the era. The transition from these qualitative, handwritten descriptions to a purely quantitative, numerical system was a slow, multi-decade process, heavily influenced by the development of mathematical modeling and statistical analysis in the mid-20th century. In the year 1956, an engineer named Bill Fair and a mathematician named Earl Isaac formed a partnership in California, starting a small consultancy firm that would eventually change the way the entire world views consumer borrowing. They hypothesized, and later proved through rigorous empirical data, that a person's past financial behavior could be distilled into a standardized formula, which would yield a three-digit number, specifically ranging between 300 and 850, to predict the statistical probability of a borrower defaulting on a loan within a specified 24-month window. This three-digit scale, which remains the bedrock of American consumer finance today, operates on a very specific logic, where a lower number indicates a higher statistical risk, and a higher number suggests a lower probability of delinquency, creating a uniform standard that eliminated personal bias, but introduced an entirely new, highly bureaucratic system of mathematical classification. As we begin this slow journey through the mechanics of this system, it is helpful to visualize the sheer scale of data processing involved, where millions of individual financial transactions, including monthly credit card balances, auto loan payments, and mortgage histories, are constantly fed into centralized computer servers, which run day and night, calculating and recalculating these three-digit figures for over 200 million American adults. Closing. This complex data ecosystem, which functions quietly in the background of everyday life, forms the foundational landscape for our next deep dive, where we will examine the precise mathematical factors that compose these numbers. To understand how these numbers are generated, we must carefully dissect the individual components of the standard scoring models, which treat every single financial action as a piece of data to be weighted, cataloged, and processed. The three-digit score, spanning from 300 to 850, is not just a random assignment, but is instead the result of 5 specific, mathematically weighted categories, each designated with a fixed percentage of importance by the scoring algorithms. The largest single component, accounting for exactly 35% of the entire calculation, is an individual's payment history, which simply tracks whether payments were made on time, or if they were missed by 30, 60, or 90 days. This means, from a statistical perspective, that the consistency of your monthly behavior carries the most weight, as the algorithm views a single missed payment from 3 years ago as a historical data point that must gradually decay in significance over a 7-year legal retention period. Interestingly, though not particularly surprising to those who study data science, the second largest factor, which comprises exactly 30% of the total score, is known as credit utilization, or the total amount of debt owed relative to the total available credit limits. If you're still following along, which most people are at this point, you might notice how this creates a delicate ratio, where a consumer who utilizes a small fraction of their limit, say less than 10%, is statistically rewarded, while someone who utilizes 90% is penalized, regardless of whether they pay the balance in full every single month. The remaining 35% of the score is divided into 3 smaller, yet equally rigid, subcategories, which the algorithm analyzes with absolute precision. Length of credit history, which contributes 15%, looks at the average age of all open accounts, meaning that an older account, even if it sits completely dormant in a drawer, provides a stabilizing anchor for the mathematical average. Types of credit used, often referred to as credit mix, accounts for 10%, evaluating whether a borrower can responsibly manage different forms of debt, such as revolving accounts like credit cards, and installment accounts like auto loans or mortgages. Finally, new credit inquiries make up the remaining 10%, tracking how often an individual applies for new loans within a short time frame, as multiple applications can signal to the algorithm that a consumer is experiencing a sudden, statistically risky need for external funding. To visualize this, imagine a massive, electronic scale, balanced perfectly on a digital platform, where every single billing cycle adds or removes tiny, microscopic weights, causing the 3-digit number to fluctuate slightly, up or down, by a few points every 30 days. This continuous recalculation happens without human intervention, driven entirely by automated data feeds from thousands of participating financial institutions, who report their ledgers directly to the credit bureaus at the end of every statement period. This automated collection of data flows seamlessly into 3 massive databases, which leads us directly to our next topic, where we will explore the entities responsible for holding these records. The data that feeds these mathematical models does not exist in a vacuum, but is instead collected, stored, and managed by 3 primary, independent consumer reporting agencies within the United States, namely Equifax, Experian, and TransUnion. These 3 entities, which are publicly traded, for-profit corporations, rather than government agencies as many mistakenly believe, operate massive data repositories located in secure, climate-controlled server facilities across the country. Equifax, which has its corporate roots extending back to 1899 under its original name, the retail credit company, maintains its primary operations in Atlanta, Georgia, where it processes billions of data points every week. Experian, with operational headquarters in Costa Mesa, California, and global roots in the United Kingdom, manages a similarly vast infrastructure, utilizing complex database architectures to track the habits of millions of consumers. TransUnion, established originally in 1968 as a railcar leasing company before pivoting to credit reporting, rounds out the triad from its base in Chicago, Illinois, completing the network that monitors American consumer behavior. Each of these 3 corporations maintains its own distinct database, meaning that the information contained in your Equifax file may differ slightly from your Experian or TransUnion files, due to variations in how and when local creditors choose to report information. For instance, a small regional bank in Ohio might only report its auto loan data to TransUnion, while a large national credit card issuer based in Delaware will systematically report to all 3 bureaus simultaneously, creating minor discrepancies in the raw data. What happened next, and this is where it gets, well, not more exciting, But different is that these variations in raw data often result in three completely distinct credit scores for the exact same individual, even if the identical mathematical formula is applied to all three profiles. Certain historians argue, and we'll explore this later, that this fragmented system was a natural result of the decentralized nature of early American banking, where local institutions preferred dealing with regional bureaus rather than a single, centralized national repository. The bureaus themselves do not actually calculate your score until a lender specifically requests it. Instead, they act as massive digital filing cabinets, holding chronological records of your open accounts, payment statuses, public records such as bankruptcies, and historical address listings. When a bank or a mortgage lender initiates what is known as a hard inquiry, they pay a small fee to one or more of these bureaus to pull the raw data file, which is then fed through a chosen scoring model to generate the three-digit number on demand. This process, which takes only a fraction of a second in the modern era of high-speed internet and cloud computing, once required physical mail requests and manual lookups, illustrating how the bureaucratic machinery of consumer finance has evolved to become completely instantaneous, yet entirely unseen by the average citizen. Understanding the distinction between these three corporate repositories sets the stage for a critical comparison as we move forward to analyze the two competing formulas that dominate the industry. When a credit score is generated, the outcome depends heavily on which specific mathematical formula is applied to the consumer's file, with the two primary competitors being the FICO score, created by the Fair Isaac Corporation, and the Vantage score, which was developed jointly by the three major credit bureaus in 2006. The FICO score, which has been the traditional industry standard for decades, is utilized in the vast majority of mortgage lending decisions, particularly those governed by government-sponsored enterprises like Fannie Mae and Freddie Mac. FICO has released multiple iterations of its formula over the years, known as FICO Score 8, FICO Score 9, and the more recent FICO Score 10, each featuring subtle adjustments to how data is weighted, such as how paid collection accounts or medical debts are treated by the algorithm. Vantage Score, on the other hand, was created as a direct corporate competitor, aiming to establish a more consistent methodology across all three credit bureaus by using a single, unified formula applied to the separate databases. While early versions of Vantage Score used a different numerical scale, starting at 501 and ending at 990, the modern versions, including Vantage Score 3.0 and 4.0, have aligned with the traditional 300 to 850 range to reduce consumer confusion. Now, you might wonder, and yes, many financial analysts have wondered too, why there are still two distinct systems coexisting in the same marketplace. But before we discuss that, there's something rather unremarkable about the way Vantage Score handles individuals with limited credit histories, allowing them to receive a score after only a few months of account activity, whereas FICO strictly requires a minimum of 6 months of history on at least one account before a score can be generated. This fundamental difference in algorithmic logic means that a person who is relatively new to the financial system, such as a recent immigrant or a young adult, might possess a perfectly valid Vantage score of 720, while simultaneously having no FICO score whatsoever, a state often referred to as being credit invisible by industry regulators. Furthermore, FICO tends to penalize multiple credit inquiries more strictly unless they occur within a specific, narrow rate shopping window for mortgages or auto loans, typically spanning 14 to 45 days, depending on the version of the model being utilized. Vantage Score employs a different triaging method for inquiries, grouping all consumer loan inquiries within a 14-day window into a single event, regardless of the type of loan being sought, which can lead to variance between the two scores. As these two corporate entities continue to refine their mathematical algorithms, lenders choose which model to purchase based on their specific risk tolerance, historical data preferences, and regulatory requirements, resulting in a dual-system landscape where the consumer must understand that they do not have just one single credit score, but rather dozens of variations depending on the model, the bureau, and the industry-specific overlay being applied to their profile. With these two competing frameworks established, we can begin to unpack and dismantle the many widespread misconceptions that confuse consumers as they navigate this numerical matrix. There are numerous persistent misconceptions surrounding the management of credit profiles, many of which stem from a fundamental misunderstanding of how data is collected and processed by the automated scoring algorithms. One of the most common myths, which has circulated for decades through word of mouth and poorly researched financial advice, is the belief that checking your own credit score will cause the number to drop. In reality, the system differentiates clearly between two distinct types of access, known formally as hard inquiries and soft inquiries, each having a completely different impact on the mathematical formula. A hard inquiry occurs when a third-party lender, such as a credit card company, a bank, or an auto dealership, evaluates your report to make an actual lending decision, an event that is recorded on your file and can reduce your score by a few points for a short period. Conversely, a soft inquiry occurs when you check your own score through a monitoring service, or when an employer conducts a background check, or when a credit card issuer pre-approves you for an offer. These soft inquiries are completely invisible to external lenders, are not factored into the scoring algorithms, and have absolutely zero impact on your numerical rating, meaning you can check your history daily without causing any damage whatsoever. If you're finding this relaxing, you might want to check the description below for more details on credit documentation. But continuing on with our exploration of misconceptions, another incredibly pervasive myth is the idea that carrying a monthly balance on a credit card and paying interest to the bank is somehow necessary to build a high credit score. This particular belief is not only factually incorrect, but it also costs consumers millions of dollars annually in unnecessary interest charges, as the scoring models do not evaluate whether you pay interest, but rather whether your statement shows a positive history of on-time payments. The credit card issuer reports your statement balance to the bureaus once a month, typically on your closing date, and whether you pay that balance in full to avoid interest, or pay only the minimum and carry the rest over, the algorithm sees the exact same data point regarding payment compliance. Therefore, maintaining a zero-interest strategy by paying your statement balance completely every month satisfies the 35% payment history metric perfectly, while simultaneously keeping your credit utilization ratio low, demonstrating that financial responsibility, rather than debt accumulation, is what the algorithm is designed to reward. Now that we have dismantled these primary misconceptions, we can turn our attention to the practical importance of these numbers within the broader context of the American economic system. In the United States, the three-digit credit score has evolved from a simple tool for bank loan officers into a pervasive socio-economic metric that influences many aspects of an individual's daily life, far beyond the realm of traditional borrowing. For instance, when an individual attempts to rent an apartment, landlords routinely request a credit report, utilizing the score as a proxy metric to gauge the likelihood that a tenant will pay their rent on time or violate lease terms. A lower score can result in a rental application being summarily denied, or it may require the applicant to provide a significantly larger security deposit, or secure a co-signer who agrees to assume full financial liability for the lease contract. Similarly, utility companies, including providers of electricity, natural gas, water, and cellular phone services, frequently check credit profiles before establishing new service accounts, mandating upfront cash deposits from individuals whose numbers fall below a certain corporate threshold. What happened next, and this is where it gets, well, not more exciting, but different, is that the insurance industry also adopted the use of credit data, creating a specialized metric known as a credit-based insurance score, which companies use to help determine premiums for auto and homeowners insurance policies. Certain historians argue, and we'll explore this later, that the link between credit history and driving risk is purely statistical rather than causal, yet actuarial data shows that individuals with higher credit scores tend to file fewer insurance claims, leading most states to allow insurance companies to charge higher premiums to drivers with poor credit profiles, even if those drivers have completely clean accident records. Furthermore, many employers, particularly those in the financial services, defense, or government sectors, conduct credit background checks as part of the pre-employment screening process, operating under the theory that high levels of personal debt or a history of financial delinquency could make an employee vulnerable to bribery, theft, or unethical behavior. This means that a number originally designed to streamline department store charge accounts has become a critical gatekeeper for housing, employment, transportation, and basic utilities, reinforcing a rigid digital hierarchy where a single numerical score dictates the baseline cost of participating in modern American society. Having observed the wide-reaching consequences of this system, it becomes necessary to look at the practical methods used to navigate and optimize one's position within it. For an individual wishing to alter their standing within this mathematical framework, the process requires a systematic, data-driven approach that aligns precisely with how the scoring algorithms interpret consumer information. Since payment history represents 35% of the score, the absolute most critical action is the elimination of late payments through the implementation of automated monthly minimum transfers, ensuring that the credit bureau never receives a 30-day delinquency notification. If a delinquency has already occurred in the past, its negative mathematical impact will slowly diminish over time, provided that no new negative markers are added to the file, as older data points are heavily discounted by modern iterations of both FICO and VantageScore. The quickest method to see a numerical adjustment involves the credit utilization ratio, which, as we noted earlier, constitutes 30% of the score and has no historical memory within most standard models. This means that if a consumer has a high utilization rate of 80% in January, causing their score to drop, and they pay down the entire balance in February to 5%, the score will fully recover as soon as the new, lower balance is reported by the creditor, completely erasing the previous month's penalty. Now, you might wonder, and yes, many financial advisors have wondered too, what exactly happens if you request a credit limit increase without changing your spending habits? But before we discuss that, there's something rather unremarkable about the basic math of a utilization ratio, which is simply a fraction where the numerator is your debt and the denominator is your limit. By increasing the denominator, meaning asking your current credit card issuer to increase your available limit from $5,000 to $10,000, you immediately cut your utilization ratio in half, assuming your spending remains static, which provides an instant boost to the score without requiring an immediate cash layout to pay down existing balances. Another tactical approach involves the deliberate management of the average age of accounts, where consumers should refrain from closing old, unused credit cards, especially those with no annual fees, because closing an account can eventually shorten the recorded length of credit history and reduce the total available credit limit, both of which can negatively impact the final calculation. Additionally, individuals can utilize programs that allow utility and telecommunication payments to be added to their credit files, introducing positive, non-traditional payment data into a thin file, thereby providing the algorithm with more material to process and potentially accelerating the stabilization of the three-digit number. These optimization strategies rely entirely on the accuracy of the data being reported, which brings us to the bureaucratic processes involved in auditing and correcting these records. Because the credit reporting system relies on the automated transmission of trillions of data points from thousands of disparate sources, errors within consumer credit files are remarkably common, necessitating a formal legal mechanism for correction. The Fair Credit Reporting Act, a federal statute enacted by the United States Congress in 1970, provides consumers with the legal right to dispute any inaccurate, incomplete, or unverifiable information contained within their bureau reports. When an individual identifies an error, such as an account that does not belong to them, or an incorrect payment status, they must initiate a formal dispute process with each individual bureau displaying the mistake. as the corporations do not automatically share dispute data with one another. This process historically involved drafting a physical dispute letter, attaching photocopies of supporting documentation, such as bank statements or canceled checks, and sending it via certified mail to the specific processing centers maintained by Equifax, Experian, or TransUnion. Interestingly, though not particularly surprising given the volume of paperwork involved, the modern dispute framework has largely shifted to online portals, where automated algorithms parse the consumer's submission, assigning a simplified 3-digit dispute code to the case before forwarding it to the original creditor for verification. If you're still following along, which most people are at this point, you might be interested to know that under federal law, the credit bureaus are strictly required to investigate the dispute within 30 days of receipt, contacting the reporting creditor and asking them to verify the legitimacy of the disputed item. If the creditor fails to respond within this statutory 30-day window, or if they cannot produce the original documentation to substantiate the debt, the credit bureau is legally mandated to permanently remove the inaccurate information from the consumer's file. This bureaucratic checking mechanism places the ultimate burden of proof on the financial institutions, meaning that diligent record-keeping and systematic monitoring by the consumer are essential tools for maintaining an unblemished credit profile, as even a minor typographical error by a bank clerk can result in significant financial penalties if left uncorrected. The legal structures that govern these disputes are part of a broader historical evolution of consumer protections, which we will examine next to understand how the current system became so rigidly codified. To fully comprehend the contemporary American credit landscape, one must trace the legislative history that transformed the industry from an unregulated, secretive network of private investigators into a heavily supervised corporate matrix. Prior to the late 1960s, consumer reporting agencies operated with virtually no oversight, often collecting highly personal, non-financial information about citizens, including details regarding their marital status, political affiliations, sexual orientation, and general lifestyle habits. These files, which were sold to employers and insurers without the consumer's knowledge, were completely inaccessible to the public, meaning an individual could be denied a job or a home loan based on anonymous, false allegations with absolutely no avenue for recourse. This lack of transparency led to widespread public outcry, prompting Congress to intervene with the passage of the Fair Credit Reporting Act of 1970, which established the foundational principle that consumers have a right to privacy, accuracy, and fairness regarding their personal data. What happened next, and this is where it gets, well, not more exciting, but different, was the realization that additional protections were needed to prevent systemic discrimination in the lending process itself. Certain historians argue, and we'll explore this later, that early automated scoring systems were designed specifically to bypass the overt discrimination prevalent in manual banking practices, yet supplementary laws were still required to ensure true equity. In 1974, the Equal Credit Opportunity Act was passed into law, making it strictly illegal for any creditor to discriminate against an applicant on the basis of race, color, religion, national origin, sex, marital status, age, or because they receive public assistance. This legislation forced the creators of credit scoring models to completely scrub their algorithms of any demographic variables, ensuring that the 3-digit number would be calculated purely on financial transaction history rather than personal identity factors. Later, in 2003, the Fair and Accurate Credit Transactions Act, known as FACTA, amended the original framework, granting every American citizen the right to obtain one completely free copy of their credit report from each of the 3 major bureaus once every 12 months through a centralized, government-mandated website, establishing the modern standard of transparency that allows individuals to audit the bureaucratic machinery that tracks their financial existence. This legislative evolution created a highly standardized system, which in turn allowed for the development of modern credit monitoring tools that track our numbers in real time. In the current era of digital banking, The management of credit profiles has shifted from an annual auditing task into a continuous, real-time monitoring process powered by consumer-facing software applications and automated alert systems. These modern credit monitoring services, which are provided by financial technology firms, credit card issuers, and the bureaus themselves, connect directly via secure application programming interfaces to the core databases of Equifax, Experian, and TransUnion. Every time a consumer opens a monitoring application on their smartphone, a soft inquiry is generated, prompting the software to pull the most recent data points and display an updated version of either the FICO or Vantage score model. The system operates on an automated trigger framework, where specific events within the bureau databases, such as the opening of a new account, a change in a reported address, or a sudden spike in utilization, will instantly generate a push notification or email alert to the consumer. Now, you might wonder, and yes, many software engineers have wondered too, how these applications can provide these complex data streams completely free of charge to the end user. But before we discuss that, there's something rather unremarkable about the monetization strategies of financial technology platforms, which typically rely on using the consumer's credit data to recommend specific, targeted financial products, such as credit cards or personal loans, earning a referral fee from the bank whenever a user applies. This continuous stream of feedback allows consumers to observe the direct, short-term consequences of their financial behavior, demystifying the numerical fluctuations that previously seemed random or arbitrary. For example, a user can see exactly how a new auto loan inquiry reduces their score by 4 points on a Tuesday, and how that same score stabilizes 3 months later as a consistent payment history is established. However, this constant access can also induce unnecessary anxiety, as the daily or weekly fluctuations of a few points are completely normal, reflecting the minor variations in statement closing dates and data transmission schedules among various creditors, rather than any structural change in the borrower's fundamental creditworthiness. Understanding these real-time digital systems allows us to look more closely at the specific mathematical distributions of these scores across the entire American population. When we analyze the aggregate data compiled by the major credit bureaus, we can observe a distinct statistical distribution of scores across the American population, which lenders categorize into specific operational tiers to determine loan eligibility and interest rates. The complete mathematical range of 300 to 850 is typically broken down into 5 distinct categories, though the precise boundaries can vary slightly depending on the specific financial institution and the macroeconomic environment. At the lowest end of the spectrum, scores ranging from 300 to 579 are classified as poor, representing individuals who possess significant delinquencies, public records, or recent bankruptcies, and who are statistically considered high-risk borrowers by the scoring models. The next tier, spanning from 580 to 669, is designated as fair, comprising consumers who may have minor blemishes, occasional late payments, or high utilization rates, but who still maintain a basic level of engagement with the formal banking system. Interestingly, though not particularly surprising to statisticians, the median credit score in the United States generally hovers around 715, placing the average American citizen squarely within the good credit tier, which typically ranges from 670 to 739. This average reflects a stable balance of consistent payments and moderate utilization across the broader population, serving as the baseline benchmark for standard consumer credit products. Moving up the scale, scores from 740 to 799 are classified as very good, signaled to lenders that the individual has demonstrated a long-term pattern of highly responsible financial behavior, resulting in preferred interest rates and streamlined approval processes. Finally, the topmost tier, extending from 800 to the maximum score of 850, is designated as exceptional, an elite mathematical category achieved by only a small percentage of the population, characterized by flawless payment histories, extremely long account ages, diverse credit mixes, and near-zero utilization rates. Lenders use these rigid tiers to automate their underwriting systems, meaning that a consumer whose score sits at 739 might face a significantly higher interest rate on an auto loan than a consumer whose score sits at 740, illustrating how a single, solitary point can cross a bureaucratic threshold and alter the real-world cost of capital for a borrower. These statistical classifications form the basis of institutional risk management, which leads us to examine the deeper macroeconomic implications of these credit scores during periods of economic shifting. The functionality and predictive accuracy of consumer credit scores are deeply intertwined with broader macroeconomic cycles, fluctuating in tandem with employment rates, inflation, and the monetary policies enacted by the Federal Reserve. During periods of economic expansion, characterized by low unemployment and rising wages, consumer defaults typically decline, causing the aggregate average credit score across the nation to migrate upward as individuals maintain the cash flow necessary to service their debt. In these stable times, commercial banks often lower their underwriting thresholds, extending credit to individuals in the fair or good tiers with fewer restrictions, as their institutional risk tolerance increases. Conversely, during macroeconomic contractions or recessions, the scoring system faces systemic stress testing, as widespread job losses disrupt the regular payment schedules that feed the 35% payment history metric. Share this with someone else who enjoys historical details before bed, if you feel like it. But as we look closer at these economic contractions, you might notice how a sudden drop in consumer incomes leads to a cascade of missed payments, causing millions of individual scores to adjust downward simultaneously. This downward shift forces the automated algorithms to recalculate risk profiles on a massive scale, triggering automated credit limit reductions from cautious card issuers who want to limit their exposure to potential defaults. This phenomenon, known within the banking industry as line clipping, can inadvertently harm a consumer's credit score further, because reducing an available credit limit instantly increases the individual's credit utilization ratio, even if their underlying spending remains completely unchanged. Thus, the scoring system can sometimes act as a procyclical mechanism, amplifying the financial constraints on consumers during economic downturns, and demonstrating that the three-digit number is not just an isolated measure of personal character, but also a reflection of the broader economic environment in which the individual operates. Closing. Having analyzed how macroeconomic forces impact these numbers, we can now turn to an examination of the specific legal documentation that records this information. To understand the raw material that the scoring algorithms parse to generate the three-digit number, one must carefully examine the structural anatomy of an official consumer credit report document. A standard report, whether generated by Equifax, Experian, or TransUnion, is organized into four highly structured, bureaucratic sections, designed to present a comprehensive financial history in a standardized format. The first section contains personal identifying information, including the consumer's full legal name, known variations or aliases, current and previous residential addresses, date of birth, and masked social security number, serving purely to ensure the data belongs to the correct individual. The second and largest section is the account history, often referred to as trade lines, which catalogs every credit account opened in the consumer's name over the past 7 to 10 years, organized by the name of the financial institution. What happened next, and this is where it gets, well, not more exciting, but different, is that each trade line contains a highly detailed subledger, showing the exact date the account was opened, the original loan amount or credit limit, the current balance, and a month-by-month grid of payment compliance status for the past 24 to 84 months. Certain historians argue, and we'll explore this later, that this highly granular grid format was designed specifically to allow early computer mainframes to read data sequentially without needing complex text interpretation software. The third section of the document covers public records, which is strictly limited to major legal financial events, such as Chapter 7 or Chapter 13 bankruptcies, filed in federal courts, as other public records like tax liens and civil judgments were removed from reports due to accuracy disputes in recent years. Finally, the fourth section contains the inquiry log, which lists every entity that has requested the consumer's data over the past 2 years, divided clearly into hard inquiries, which are visible to external lenders, and soft inquiries, which are visible only to the consumer, providing a complete, chronological trail of an individual's attempts to secure financing within the American financial system. This detailed documentation provides the empirical foundation for the entire scoring apparatus, leading us to our penultimate discussion on the future technological trajectories of credit tracking. As the financial technology sector continues to evolve, the traditional methods of generating credit scores are undergoing a gradual transition, driven by the integration of alternative data streams and machine learning algorithms. Traditional scoring models, which rely exclusively on historical debt repayment data, are increasingly viewed by certain modern institutions as incomplete, particularly when evaluating younger generations or underserved populations who may not have traditional mortgages or credit cards. To bridge this data gap, the credit bureaus and independent analytics firms have developed new frameworks, such as FICO Score XD and UltraRich, which incorporate non-traditional financial indicators into the algorithmic matrix. These alternative metrics include the consistent payment of residential rent, monthly subscription services, streaming platforms, and regular checking and savings account cash flow patterns, which are gathered via secure open banking protocols with the explicit permission of the consumer. Now, you might wonder, and yes, many data privacy advocates have wondered too, how the inclusion of these real-time cash flow metrics alters the stability of the consumer scoring environment. But before we discuss that, there's something rather unremarkable about the way machine learning models handle large datasets, often identifying subtle patterns that human analysts might overlook, such as a statistical correlation between the exact time of day a bill is paid and the long-term likelihood of default. This shift toward alternative data allows the automated systems to construct a more holistic, real-time representation of an individual's financial habits, reducing the time required to build a viable credit profile from several years down to a few months. However, this technological trajectory also introduces new complexities, as the use of proprietary, black box artificial intelligence models can make it more difficult for a consumer to understand exactly why their score changed, or how to dispute a specific algorithmic deduction, highlighting an ongoing tension between technological efficiency and consumer transparency within the modern regulatory framework. This look into future technological horizons brings us to our final segment, where we will summarize our exploration and provide a soft conclusion to our journey through the numbers. We have traced the extensive architecture of the American consumer credit scoring system, moving slowly from the handwritten leather ledgers of the 19th century to the real-time cloud-based algorithms that govern contemporary finance. We have examined the precise mathematical factors that compose the standard 3-digit scale, noting how payment history, credit utilization, account length, credit mix, and new inquiries are meticulously weighted to produce a single, influential number. We have analyzed the separate corporate roles of Equifax, Experian, and TransUnion, and compared the operational differences between the traditional FICO models and the newer Vantage score formulas. Through this slow exploration, the widespread myths surrounding credit monitoring have been dismantled, replaced by a clear understanding of the difference between hard and soft inquiries, and the strategic value of maintaining low utilization ratios. What happened next, and this is where it gets, well, not more exciting, but different, is that we observed how this numerical matrix extends its reach far beyond simple bank loans, acting as a structural gatekeeper for housing, insurance premiums, and employment opportunities across the nation. Certain historians argue, and we'll explore this later, that the rigidity of this system creates a digital record from which it is difficult to escape. Yet the legal frameworks established by the Fair Credit Reporting Act ensure that every consumer retains the right to audit, dispute, and correct the data held in their files. Go to sleep now. You know what it is. You understand that the 3-digit score is simply an automated, mathematical reflection of historical transaction data, operating entirely on cold, predictable formulas devoid of personal judgment or emotion. As the server farms continue to hum quietly in the background of the night, calculating balances and updating records, you can rest assured that the rules of this numerical game are logical, structured, and entirely manageable through patient, consistent habits. There is nothing more to solve tonight, no balances to check, and no reports to audit. The numbers will remain stable, waiting quietly until the morning comes. With this complete understanding of the financial matrix, we conclude our tedious journey through the numbers, allowing the mind to rest as the data streams fade into silence.